Hello everyone, welcome to Yadnya Investment Academy. Today in this video we are going to talk about fiscal deficit and its comparison with revenue deficit and primary deficit. Before we understand about fiscal deficit, we should know about various types of revenues and expenditures of Indian government. First, let's talk about the incomes. One type of income is revenue receipts. These are basically the regular income which government gets from both tax and non-tax revenue. These are the earnings made by the government which neither creates liabilities nor reduce assets of the government. All type of tax revenues comes under this category. Interest on investments, dividend earnings and earnings from services provided also comes under this category. Second type of income source of government is capital receipts. These are the earnings made by the government which creates liabilities such as borrowings from public in form of PPF, small saving deposit, national pension scheme, etc. Or they can also reduce assets like divesting stake in a particular government company called disinvestment or recovering loans made to state governments. So these all are called capital receipts. Then there are two types of expenditures as well. Revenue expenditure, it is the expenditure made by the government on a recurring basis, which is a yearly basis, such as administrative expenses, interest payment on loan taken by the government, pensions, subsidies, etc. Then there are capital expenditure. Now these are productive, asset creating or liability reducing long period non-recurring expenditure of the government. For example, expenditure on creating the infrastructure like roads, electricity, dams, etc. Loans made to state government and repayment of loans by the central government are all called as capital expenditure. Now fiscal deficit is made from two terms, fiscal and deficit. Let us start by looking at these two terms first. Fiscal means yearly. That is, the data collected is for 1 year and hence not cumulated with the previous years. And deficit, as we know, is the amount of by which a resource falls short of a mark, most often used to describe a difference between cash inflows and outflows. Now, fiscal deficit occurs when a government's total expenditure, which includes both revenue and capital expenditure, exceeds the total revenue that it has generated, excluding the government borrowings. So, this is the equation which basically tells you about the fiscal deficit, or it can be also represented like this. So, if we actually add borrowings in this total receipts, fiscal deficit is 0. So therefore fiscal deficit actually gives you the requirement of borrowing for the government. We will all understand this better with a detailed example. Before that, let's understand what is revenue deficit and primary deficit. Now revenue deficit is excess of total revenue expenditure of government over its total revenue receipts. So it only deals with revenue expenditure and revenue receipts and doesn't include capital expenditure and capital receipts. So revenue deficit signifies that government's own earning is insufficient to meet normal functioning of government departments and provision of various services which government offers. Now let's understand what is primary deficit. Now primary deficit is defined as fiscal deficit of current year minus interest payments on previous borrowings. So in other words, whereas fiscal deficit indicates borrowing requirement inclusive of interest payments, primary deficit indicates borrowing requirement exclusive of interest payments. So we have seen that borrowing requirement of government includes not only the accumulated debt but also interest payment on debt. So if we deduct interest payment on debt from borrowing, balance is called primary deficit. It shows how much government borrowing is going to meet expenses other than interest payments. Thus, zero primary deficit means that government has resort to borrowing only to make interest payments of previous debt which government had borrowed. So this is how primary deficit equation is presented. Now let's understand all these three with an example. So let's see all these figures. Revenue receipts, which includes both tax and non-tax revenue, is suppose 3 lakh crores of the government. Capital receipt is suppose 1,60,000 crores, which includes both these things. Which means total receipts of the government is this plus this, which means 4,60,000 crores. Then there are expenditures. So suppose revenue expenditure, which includes all this, is rupees 3,50,000 crores, and it includes these two things: interest payments, which is 1,20,000 crores, and other expenditure which we listed above. Capital expenditure suppose is, which is includes all these things, is rupees 1,10,000 crores. So total expenditure is this plus this. Now fiscal deficit in this case will be rupees 1,50,000 crores, which is equivalent to the borrowings government has to do to meet this deficit. And the revenue deficit in this case will be revenue receipts minus revenue expenditure, which is 50,000 crore rupees. And the primary deficit here will be fiscal deficit minus the interest payments. So primary deficit is only rupees 30,000 crores. So this figure shows the borrowing government needs to make to meet total budget shortfall. This shows the shortfall on revenue budget of the government, which needs to be met by either borrowings or increasing capital revenue. And this figure shows the actual total budget shortfall if we don't consider interest payments on previous loans. Now let's understand how is this fiscal deficit financed by the government. So there are various ways. First is borrowings from domestic sources. Fiscal deficit can be met by borrowing from domestic sources, example public or commercial banks. It also includes tapping of money deposits in provident fund and small saving schemes. Borrowing through issuing government bonds are also done time to time to meet their fiscal deficit demands. Second is government can borrow from external sources like World Bank, IMF and foreign banks. Third way is through deficit financing, or also called printing of new currency notes. It is basically government borrows from RBI. Government issues treasury bills which RBI buys in return for cash from government. And this cash is created by printing new currency by RBI against the government securities, and thus it is an easy way to raise funds, but it creates adverse effects also. Its implication is that money supply increases in the economy, which can create inflationary trends. The fourth way is through better fiscal policies, which can be done by increase in taxes, which can lead to increase in revenue of the government, which in turn would reduce the deficit. But obviously increase in taxes is not very popular among the people. And one of the big reason of not reducing petrol price by the government recently is to keep fiscal deficit in check. Second is reducing government spending. Government can also cover its deficit by reducing government spending. That can be done by reducing subsidies or reducing the expenditure on infrastructure, etc. Now question comes, is fiscal deficit advantageous to the economy? Now it depends upon its use. Fiscal deficit can be advantageous to economy if it creates new capital assets, which increases productive capacity and generate future income stream. On the contrary, it can be detrimental for the economy if it is used just to cover revenue deficit. Now we will look at fiscal deficit of India. Fiscal deficit of India is calculated as a percentage of GDP. And in 2017-18, government's fiscal deficit was 3.2% of GDP, and in 2018-19, government has target of 3.3% of GDP as fiscal deficit. In the last 5 years, fiscal deficit of India has reduced. It means government has cut the government expenditure or the revenue has increased, and the primary deficit has almost become negligible in the last year. So that is all we have on this topic. If you have any question, please do write in the comment section below. Before we close, we want to tell you about our new book on mutual funds, which is available on Amazon and Flipkart. More details in the description of the video. That is all. Jai Hind and have a great time ahead.